One of the most popular features on Trading 212 is the ability to create pies, where you can manage up to 50 stocks or ETFs in a mini portfolio. But if you don't use them in the right way, you could be making some costly mistakes with your investing, and some are less obvious than others. If you're not familiar with what a pie is, it's essentially a feature that allows you to group together investments. You can have a mix of individual holdings as well as ETFs. So instead of having to buy each holding individually, you can put them inside a pie and it will automatically split out your investment based on your chosen weightings. You can also auto-invest on a regular basis using the same approach. So you could tell it to invest, say, £300 per month, and the pie will take care of the allocations. Now let's get into the biggest mistakes. One of the biggest risks in creating your own portfolio is the lack of diversification. This is where you'd have too much concentration in a specific sector, region, or country. And that concentration can be either intentional or hidden. Intentional will be where you're under-diversified by going into too few holdings deliberately. So you could go into something like the Nasdaq, a very popular index in the last few years, getting exposure to US technology, or something like a precious metals fund. Those funds in themselves are not necessarily bad, and all of it depends on what else you have in your portfolio. But by just holding them on their own, you could say that you're under-diversified. On the other hand, you could be gradually adding to your investments that leaves you over-diversified. Once you get past around 5 or 6 ETFs, it's unlikely you won't have some form of overlap. And it's the ease of being able to add investments to a pie that could actually be a downside. It all starts out with wanting to be diversified, so we go into multiple investments. But we treat ETF investing the same way that we treat individual stock investing. So we go into a few because we want to spread our bets. And it may start out at just 3 or 4 different ETFs, but over time we might gradually add to that, whatever the new flavor of the month is, or whatever theme is getting exposure in the news. And we add to our portfolio without always looking at what the impact is on the wider portfolio and actually our diversification. And in a bid to actually increase your diversification by having multiple holdings, you could ironically actually be reducing your diversification. It's so easy to get carried away trying to create the perfect pie. And because you can have up to 50 holdings, that can sometimes encourage us to hold more than we actually need. We just have 2% here, 2% there. But creating it is just the start of it. Where most people fall down is actually in the maintaining and managing of it. If you've ever played fantasy football, you'll know that feeling of making a few changes to your team, looking at it on paper and feeling like, right, I'm set now for a good few weeks. You've spent so much time analysing different players for that given week and the next few weeks, and if all goes well, you could be set. But of course, things change, and you can't always predict those. And it's exactly the same in investing. You can start out and have it exactly how you feel on paper. It can look amazing, but something will always happen that you'll have to react to or to make changes to. And the more holdings you have, the more complex your portfolio, the more things that you have to manage and potentially make a decision on. For most investments, especially if you've got a long-term view, the best thing you can do is just sit back and ride it out. Some investments will be more volatile than others, but remember the reasons you invested into that in the first place. But the more investments you have in your pie and the more complex it is, the more potential things that you have to monitor or manage. There's more things you might look out for in the news. A lot of things you can ignore, but there might be some things that you might have to react to. But it also encourages you to tinker. Because you've got so many different holdings, and they could be a few %, you can keep changing those weightings from time to time. Some theme will come up in the news that you might want to add, you might want to re-weight your portfolio, and it encourages this really active play. And part of that's on the platform itself. It's designed to be easy to use. They want you to be more active in the markets. They don't want investors that just sit back and do nothing. And pies can be very useful, but they can also encourage you to make multiple decisions. So one of the most important things is to have a clear objective for each pie that you create. Know exactly what the purpose of each investment you have is. And wherever you decide at the start, make sure it's something you can stick to. And in most cases, simple is best. Yield chasing is a really good example where people might pick investments based on the yield that they give, and they want to create a dividend-focused pie, which on its own is absolutely fine. But you've got to think how you manage that. And especially if you've picked really high-yielding assets. Say, for example, one dividend period, it doesn't pay as high as it did the previous period. You've now got to analyse whether that was just a one-off. Did you go into it quite early when it was quite a high dividend yield, but maybe that wasn't sustainable? So did you do enough research into that dividend being sustainable, or did you just pick it based on its high dividend yield? Well, now you've got to do research and make a decision on whether you still want to hold that company. So again, everything that you go into, if you're picking individual stocks, make sure you've done enough research and backing to go into that holding. If you really want to simplify your investing, I have a free ETF cheat sheet that you can download. It breaks down the most popular ETFs in different regions and different sectors, makes it easy to compare. It's the top link in the description below. One of the key features of pies is that you don't have to create your own, you can actually copy someone else's. You have a choice of either going into ready-made pies, like this one from Vanguard, which is 50% equity and 50% bonds, or you can choose to copy other people's pies. And these pies can be created by anyone with a Trading 212 account. Here you can look at pies created in the last 30 days, or you can look at top performing pies. And by performance, that's a mix of the number of copiers, the investing performance, and also its engagement in the community. Now, it's one thing copying a professional fund manager with a team and massive resources behind them. It's another copying someone who just posted their portfolio online. And one of the key risks with pies is how you can find them being split out by only new and top. And for a lot of people who are just casual investors, they post their portfolio online because they're proud of what they've created. They want a little bit of status if people start to copy them. But the fact that when you first create a pie, it will go into this new section and it stays in that new section for 30 days. After that 30 days, unless you make it into the top section, that pie just disappears into the abyss. The only way for someone else to find that pie is either by you sending them the URL or they already know about it. So if a user wants to create a pie and get as many people copying it as possible, they've only got a 30-day window to get as many followers and to get enough engagement to make it into that top section. And then that encourages making more risky plays. So you want to make something that's going to get a lot of engagement and people are going to follow it because it's had really good past performance, which is obviously not a very good investing thesis. What you also can't be sure of is time horizons and goals aligning. For that one person creating that pie, that might suit them for where they are in their investing journey. They might have a different risk appetite to you. And everyone's investing portfolio is so unique to them. For sure, people can have a lot of similar investments, but just copying someone because that's what works for them isn't necessarily always a good decision for you. This also slightly overlaps with the previous point about maintaining as well, because a lot of people will create pies and it gets put into that top section because of how it's performed previously. But if they don't maintain that, when something happens that you need to make a decision, you won't know whether to make it or not. If someone does maintain a pie, in theory, I think if you copy it, you will get notified that they've made a change. But again, you won't always know the reason why they're making a change. That might just suit them for where they are right now. So when you are copying a pie, that in itself is not necessarily a bad thing because you can get quite a simple pie. But you've got to think about how you're going to manage that moving forward. One of the key things with managing an investment portfolio is keeping your weightings in check. So when you go into multiple investments, at the start, you will decide how much exposure and how much allocation you want to each one. But those will, of course, shift over time because some will outperform others more than you would expect. And then at some point, you're going to have to rebalance. And people can do this in multiple different ways. For some people, they pick a specific time period. So it could be every year you decide to rebalance. And based on what that performance has been, you might have to sell some of your winners and buy some of the losers. And you bring those weightings back to what you started at. For some people, they set a threshold. So they might say, if it shifts more than 5% away from my original allocation, then I'll make a change. That in itself on paper should be fairly straightforward, but the problem with pies is that it encourages you to rebalance far too often. It slightly goes back to that point about creating the perfect pie, because as soon as you've created it, those weightings will shift. It could be within a week. And then you've got a decision about how long you let it run for. Rebalancing is so easy because you can do it with one click. And because it's so easy to do, you can fall into the trap of doing it too often, because you're obsessed with wanting to keep your portfolio exactly what you set it as. And you may be wondering why rebalancing too often is an issue in the first place. And it's because every time you rebalance, you're essentially placing multiple buy and sell orders. When you place a trade in the market, there will usually be a spread. That's the difference between the buy and the sell price. You'll see this straight away when you buy an investment. As soon as you've bought it, it will be down slightly. And you may wonder it's only been a few seconds. And it's because if you then sell that investment straight away, the difference is generally in the spread. Trading 212 don't charge anything for dealing like other platforms do. So if you were with another platform, this would be even more of an issue. But rebalancing, because it's free, again, does encourage you. The problem is, and there is a myth around Trading 212 manipulating spreads, but this is actually illegal in the UK. They can't manipulate those spreads for their own profit. What can happen, and specifically with Trading 212, is that they don't always trade directly into the market. They'll trade something using OTC, which is over the counter. And that means within the Trading 212 community and users, if you want to sell an investment, first it will go out to its user base and see if anyone wants to buy it. And if they do, they'll just match you together and they'll act as the exchange. And for them as a platform, this is so much cheaper for them to do because they don't have to pay the fees to use an exchange. They can just trade in-house essentially. That in itself isn't necessarily a bad thing. It can be really efficient. But the reason they're doing it is to save money. And if you're investing into a market that hasn't got enough liquidity, or there's not enough buyers at a specific price in their user base, and you're still trading OTC, then that spread could widen. Not because they've manipulated that spread wider to profit from, but just due to a lack of liquidity. When you're placing a deal, it's always worthwhile comparing what price you've been given on the platform you're using, and then you can also look at what it is actually on the stock market. And you can see how much more you potentially might be paying than what the actual stock price is. Because when you buy that investment and then you see it suddenly down 1%, and you're doing that multiple times, it could be you're rebalancing every week. That's where you just could be losing so much money. The other thing you've got to factor in is FX costs. So if you're not trading into UK companies, there will be an FX fee that you'll have to pay to trade US companies, for example. Now, again, if you're making multiple trades, that can soon add up. The other thing with rebalancing too often is that you're not letting your winners run, and you're also not capitalizing on your losers potentially underperforming. The reason your weightings are shifting is because one of your investments is outperforming the other. Of course, at some point you will need to rebalance because you want to stay diversified and keep those weightings what you selected at the start. But when a company gets some positive news and it starts going on a run and it starts to rally, you want to let it do its thing. You don't want to cap those gains too early. And likewise, if a stock starts to underperform, when you rebalance, you're going to buy those underweight stocks. If a share price is falling, it's like buying the bottom. You want to buy when it's as low as possible, and likewise when it's at the top. When you let those winners run and you then rebalance, say, on an annual basis, it's like taking profit at the top. You're capping those winners when it's had a decent run. And that's why I prefer a rebalancing approach where you just set a time frame. It could be 6 months, it could be a year, could be even longer if you wanted. But be really strict with it, and then it takes all the emotion out of it. So whatever's happening in the markets, it doesn't matter because you've got your schedule and you'll rebalance at that point. So try to avoid that urge of pressing that rebalance button too often and making your percentages match up, because it could be costing you money. I should say that everything we've discussed in this video doesn't necessarily mean that pies are bad. They can be useful, they just need to be used in the right way. Whether that's grouping investments together, whether it's the ability to auto-invest and select your weightings. When it comes to the copying, it could just be getting some idea, seeing what others are doing, and act as a starting point. For a lot of people, they prefer to have the core of their portfolio in hands-off, passive approaches, and then they might have a small percentage of their portfolio where they are a bit more active. They can play around a little bit more. I know I'm exactly the same way. I almost want to keep my hands busy because I know I like to tinker. But if I do that with a small percentage of my portfolio, I know I'm reducing my risk, but I'm also keeping myself busy. And that's where a pie can be really useful because of its features. Let me know your experience of pies down below in the comments. Hope you found that useful, and I'll catch you in the next one.